All right, so today's episode is all about tax-free investments. One of the biggest investing mistakes you can make is investing without taxes in mind. So many people fail to consider the tax implications of their investments, which is crazy because taxes dictate how much money you are actually left with from your investment gains at the end of the day. And not all investments are taxed the same way. Some investment gains can be taxed up to 50% or half of what you earned. And others can be taxed as little as 0% if you choose and structure your investments carefully. Now, this is very important because when you accumulate money tax-free, your money actually grows at a much faster rate. You can have an investment that has a high rate of return, but after all taxes are paid, the actual return is much lower than other investments. So today I'm going to share with you the top 10 tax-free investments that you can invest in and pay little to no taxes. If you're new here, my name is Sherman, the CPA, and I save investors thousands in taxes every day at mycpacoach.com. I share my real world experience here on YouTube for free, so be sure to subscribe if you want more guidance to less stress and lower taxes. With that said, let's go ahead and talk about tax-free investments. All right, so let's start with the basics. What makes an investment tax-free? Well, the tax code does. There are specific tax breaks available for various types of investments. And I'm going to share that with you in a second, but first, let's make sure you understand how investments are typically taxed in general. So most investments are taxed as either a short-term capital gain, long-term capital gain, or is tax-free due to provisions in the tax code. A short-term capital gain occurs when you sell an investment that you held for less than a year. Okay, that simple. Now, short-term capital gains are taxed as ordinary income, which could be taxed on up to 37% of your income on a federal level and up to another 13% on a state level, depending on your state. So short-term capital gains are how you can pay up to 50% of your investment gains back to the government in taxes. Then there's long-term capital gains. A long-term capital gain is an investment that you hold for over a year. Now, these investments are taxed at a lower rate, ranging from 0 to 20% depending on your income level. So long-term capital gains are much better than short-term for taxes, but still, some investments, which you're going to find out, are not taxed at all. So let's go through the list here, starting with some easy points, and then we'll warm up into some of the strategies that are used by the top 1%. All right, so number one, long-term capital gains taxed at 0%. This is very straightforward. If you earn less than about $45,000 as a single taxpayer or $90,000 as a married taxpayer, your capital gains will be taxed at 0%. Now, most investors have income above these amounts, but I have seen cases where high income individuals are able to reduce their taxable income so much so that their capital gains are actually taxed at 0%. How is this done? Well, this can be done through maximizing your tax deductions, whether it's through business investments, charitable giving, real estate, and so on. Now, I have videos on our channel that goes more in detail on these strategies, but the bottom line here is that if your taxable income is below these amounts, then you would pay 0% tax on any of your investments. It doesn't matter if you sell stocks, bonds, or other types of assets, as long as you held these assets for over a year, making it a long-term capital gain, and your income falls within this threshold, then you would pay no tax on your investment. Number two, investments that you do not sell. Another simple way to have tax-free investments is to simply not sell your investments. Your investments only become taxable once you sell them. So if you hold your investments indefinitely, you will never pay tax on them. Some people do this and simply take a loan out against their investments if and when they need cash. There are ways to borrow money against various types of assets you own, whether that's stocks, real estate, or businesses. The most common example of this is a home equity line of credit, also known as a HELOC. Basically, you can borrow money against the equity you own in your home. And when you receive that money, you pay no tax on it. And you can do this with other types of assets, such as stocks, for example. Now, obviously, you have to consider the interest rates on any type of loan, but nonetheless, this can be a great way to liquidate your investments without paying taxes. So those are two easy ones. Now let's get into some specific investments that are literally tax-free even when you receive cash flow and are accessible to almost anyone. Number 3, municipal bonds, also known as local bonds. Bonds are basically debt, except you are the lender when you buy a bond. And if you lend the government money, they will give you a tax break in return for certain types of investments. And municipal bonds are one of the most tax-friendly options. These type of bonds are typically run by local or city governments that use the funds towards things like schools, highways, or sewers, for example. They are typically exempt from federal, state, and local taxes. For example, Vanguard has a tax-exempt bond fund that pays about 4% interest at the time of this video. Now, while you ponder on if a 4% rate of return gets you excited or not, ask yourself this question. Would you rather invest into an asset with a 7% rate of return that is taxed at 40%, or an investment with a 4% rate of return with a 0% tax rate? Drop a comment below and let me know what you think. All right, number 4, Treasury securities, also known as federal debt. Treasury securities are another example of tax-free investments. Now, this involves you lending money to the federal government this time, who uses the money to fund things like the military, education systems, highways, and so on. Now, these investments are typically viewed as low risk because the US government maintains such a good credit rating, so there's a very high chance of getting your money back. Now, with that said, there are many different types of Treasury securities. There's Treasury bills, Treasury notes, Treasury bonds, and so on. But all of them are very similar. They just have different terms and features as well as their tax treatment. Now, Treasury securities are normally exempt from state and local taxes, but are typically subject to federal taxes, so be sure to look into the details of your investment. You can learn more or even buy Treasury securities at treasurydirect.gov. Now, let's level this up a notch here and look at a few tax-free investment structures that will make your investments tax-free no matter what you actually buy. Then we'll look at some more advanced structures. All right, number 5, the Roth IRA. Now, most people are familiar with this, so I will not spend too much time here. But an IRA simply stands for Individual Retirement Account. And a Roth is a certain type of account that allows your investments inside the account to grow tax-free. And once you reach retirement age, you can withdraw the funds tax-free. So because of this, many investors view this as one of the best investment structures if you care about investing for retirement. Instead of buying investments that are subject to short-term or long-term capital gains tax, you can simply buy them inside of your Roth and pay 0% tax when you take it out later. Now, there are income limits to qualify for a Roth, and if you qualify, you can contribute up to $6,500 per year at the time of this video. But even if you don't qualify, look into a strategy known as the backdoor Roth. This is a very popular workaround for high-income individuals to use the Roth strategy. But $6,500 per year may not be much for most investors, so let's go one step further with the Roth. Number 6, the Roth 401k. A Roth 401k works just like an IRA, except this is typically set up through an employer. If your employer offers a 401k plan, you can contribute up to $22,500 as an individual at the time of this video. And if you are self-employed, even better. You can set this up for yourself and contribute up to $66,000 per year, depending on your income. Now, I have various videos on this topic, so be sure to subscribe if you want to learn more. Now, although Roth 401ks and IRAs are incredibly beneficial, some people cannot fathom locking their money up into these types of accounts. And if that's you, don't worry. The next option may be right for you. All right, number 7, life insurance, also known as the rich man's Roth. So as weird as it may sound, you can invest money through a life insurance policy. And what makes this so attractive to investors is that your earnings grow tax-free, similar to a Roth IRA. And even better, unlike a retirement account, you do not have to wait until you reach a certain age to get money out when you need it. There are ways to withdraw money or borrow money from your life insurance plan at any time, depending on what the circumstances are. If you are interested in something like this, look into an index universal life insurance policy. And if you want a more in-depth video on how this works, just drop a comment below, and if I get enough of them, I'll create a video on that topic. Number 8, HSA or health savings account. A health savings account is another account where you can invest tax-free as long as you follow the requirements. So basically, you can contribute up to $8,000 per year depending on your filing status and receive the following tax benefits. Number 1, you will get a tax deduction for the amount of money you contribute to your HSA, unlike life insurance and unlike Roths. Number 2, your investment earnings will grow tax-free inside of your HSA. And number 3, your withdrawals will be tax-free if you withdraw the money for qualified health expenses. Now, a lot of people think that you can only use your HSA for doctor visits and medical procedures, but you can use your HSA to pay for all sorts of things, from gym memberships, massages, chiropractic care, doctor visits, dentist visits, and so on. And if you're interested in learning more about that, check out the video that we have about how to write off almost any health expense on our channel. Number 9, real estate. Now, real estate is one of the best tax-free investments in the world. First and foremost, if you have a capital gain from the sale of your primary residence, you can exclude up to $250,000 to $500,000 of the gain if you are married with the Section 121 exclusion. And all you have to do is live in it for 2 of the 5 most recent years to qualify for it. But let's say maybe you don't qualify for it. Maybe you own rental properties that you never lived in or you did not live in for the last few years. In that case, you can do a 1031 exchange. Or in other words, you can swap your property for another one to exclude most of the capital gain. And as it relates to income from properties, you can also offset most of your rental income by taking depreciation. Now, depreciation is a non-cash expense that can be deducted on your tax return. In many cases, depreciation can wipe out most of your rental income and even other types of income you earn if you are savvy. I have an entire real estate playlist on our channel, so again, subscribe and check that out to learn more. Number 10, business. Last but not least, your business can be used as a tax-free investment. That's if you know how to structure your entity and, more importantly, maximize your tax deductions through your business. So yes, income you earn from a business is taxable, but if you are savvy with the tax law, you can reduce your taxable income from your business to almost nothing. For example, just consider write-offs. The tax law allows business owners to write off way more expenses than ordinary individuals with W-2 jobs. Many business owners are able to write off their mortgage, rent, utilities, food, health expenses, travel expenses, and so many other items that they may also personally benefit from. All they would have to do is incur these expenses and relate them to their business in a way that complies with the tax rules. And that's just the beginning. As a business owner, you can also design retirement plans, health insurance plans, and other benefit plans that primarily benefit you as the business owner. For instance, there are retirement structures that allow you to contribute up to $300,000 per year towards your own retirement. And when the business pays for those expenses, they can write it off and report less income as a result. Or maybe you want to double down and invest more money to grow your business. Well, you can write off those types of expenses as well. You can write off expenses to buy other businesses, build new products, design new services, or advertise your business, and so much more. There are so many ways to use a business to reduce your taxes, and as you can imagine, we have videos on how to do this on our channel, so be sure to subscribe to check this out. And for immediate assistance, you can apply to become a client today at mycpacoach.com.